Good morning, good evening, wherever you are, and welcome to the Sound Trader's first podcast. I'm Graham from thesoundtrader.com, and in these podcasts, we are going to talk to real day traders. We are going to try and fill in the void between online trading forums and the market wizards by talking to guys that don't have the time to blog about their feelings. My first interviewee of the podcast series is Michael, who is a prop trader of 1 year now in Australia. Welcome, Michael, and thank you for joining us.
Yeah, thanks, Graham. Very good to be here.
Yeah, well, on a Sunday night, it's rare that you'll get someone to agree to do a interview at 10 p.m. on a Sunday night, but I suppose that's the lifestyle you are living at the moment.
Yeah, pretty much. Yeah, up late at nights. It seems to be the way things are these days.
Well, it was this time last year that you started training with your proprietary trading firm or prop shop.
Yeah, correct.
What was
It was actually pretty much exactly a year ago. Yeah.
Exactly a year ago. And what was one of the first major lessons that they taught you?
Probably two that's really stuck out to me straight away was the concept of relative value. And the other one was fading. I'll speak about fading quickly first, as it was just something that was very foreign to me. The study and the research and the analysis that I'd done prior was just basically fading was a terrible thing to do, and nothing good can come from it. And I've found doing the drills where you're learning to fade, just sort of watching my internal processes, like the amount of discomfort I was experiencing when I was just doing these drills, fading and having the market go against me and averaging in more as per the instructions of the drills. You could really feel the discomfort that I was experiencing from the belief that fading is something that you just shouldn't be doing. To sort of go from there to fading is a very core part of my strategy now. It was just such a completely different concept to anything that I'd had experience with before. So that was sort of fading, and then the other one was relative value, something I'd really never heard of, and all it really is comparing a few different markets that obviously have some relationship to each other, and investigating which ones are cheap and which ones are expensive relative to each other, because basically if you're of the opinion, just say that one of the grain markets is going up, the common logic for me to begin with was you just buy the front month because that's the most liquid, or you're at least buying a very liquid month in the not too distant future, whereas an investigation of relative value might enable you to be much more efficient in deciding which market you'll actually enter based on which one's cheap and which one's expensive, compared to what the current spot month is.
Maybe you could discuss for us what the training process was, because this is a typical prop shop. They have a course that trainees go through, an application process. You were fortunate and skilled enough to get through that. What was the format? You said you started with an online course. Take us from there.
Yeah, so the online course it was basically set up to be 1 month. You have some reading material and some there was a suggested audio book and a few things to go through prior to commencing it. But essentially it was sort of 4 weeks. The first week was all drills, and just sort of drills like one of the ones that I mentioned just then was the fading drill. Just different things to get you exposed to small components that you will end up sort of putting together to make your strategy on how you actually trade. But yeah, so essentially you got a week of drills, and then you have 3 weeks of sort of developing a strategy and trading an approach, during which like results are always going to matter a bit, but there's certainly probably more things than, did you make money or not in those 3 weeks that they're kind of looking for. And a big one of that is, were you logged in and participating for the required amount of time in a systematic method each day? That in itself sort of gets you a long way towards progressing through to an interview.
So it gets you points participating and the discipline of turning up and having a go each day.
That's right, yeah.
How long were the sessions?
You were guided to sort of begin from the reopen, from when the SFE reopened at 5:10 in the afternoon, and it was basically suggested that you go from there through to past the US Pit Open. I was basically doing from that sort of 5 o'clock in the afternoon through to 2 a.m. trading that sort of 9 hour block, 9 hour core block as what you really needed to be demonstrating that you had the capacity to do to progress.
Right off the bat, 9 hours of focus. Can you do it?
Yeah.
If you can, then we'll go to the next stage. So then you had interviews, am I right?
Yeah, there was an interview. Interview was certainly not, it was not a grilling by any means. It's probably the purpose of the interview is really demonstrating that you've got some passion for what you're doing and that you're excited to be in the industry and you've got some longevity. You're wanting to do it for your career, that you are quite serious about it. Your own logistics, like your own personal circumstances, can have a huge impact on your success or failure, and that basically comes down to when you come into the prop shop, there is no salary. Like you'll have a training period in the prop shop, and you're not actually going to be taking any money out of it until you're down the line enough where you've developed your strategy and you are consistently pulling money out of the markets. So they often suggest that, that may well mean that you are not going to be able to draw money for 6 to 12 months. And are your personal circumstances such that you believe that you've got the confidence in yourself that you're going to be able to do it? Do you have enough money to kind of last that long? All of these things. It's more of a reality check, just to make sure you know exactly what it is that you're going to be beginning. And if you've obviously thought about these things in advance, and you are okay with them and it is what you want to be doing, then you'll be fine when you're asked the questions. If you hadn't sort of thought about them and you go, oh well, I've only got a few $100 in my account, I can't really go 6 months without getting paid, the whole situation's not going to work. So that's really the importance of the interview. They're not really screening you out as far as ability or anything at that stage. You get all the logistics right, you show some passion for what you're doing, is really what they're after.
They want to make sure you can treat it as a full-time job without distractions, because that's obviously what they believe, I take it, is the focus and time requirements of success.
Yeah, correct. Yeah. And it's sort of the boring part of success. The part that it doesn't get talked about all that often, and it's all of the little bits that go into producing the result. They're all of those logistical things. Is your life set up in such a way that you are actually going to be able to do what is required? Because at the end of the day, it takes a lot of your time and a lot of your energy, and you're only going to be able to execute that well if your personal life is set up in such a way that it can support it, and you have the passion to do it.
You obviously passed that test.
Yes.
And they got you in-house. I think, what month was that last year?
In the middle of February. I commenced in-house in the middle of February. So that's basically once the official training in-house begun. There's sort of 2 to 3 weeks where, again, you're doing drills, like a couple of different drills per night, and then reviewing the drills at the end of the week, and a lot of strategy and decision making, and a lot of planning and things like that go into sort of that 3-week period. And then after that, you go on to the sim. Simulation generally probably lasts another 4 to 6 weeks. I actually think I was a little bit longer than that. I was probably 8 weeks before I was live. You're building your strategy. You're finding something that you can do in a consistent manner that matches your personality, and you're able to. It's fairly straightforward, at least in your mind, what you actually do when you sit down at your desk each day. That's sort of you can go down a few different paths, and they've given you a lot of tools and a lot of avenues you can explore, and that time is basically used to get you into that phase. So. Yeah, I think it was sort of, they say sort of 4 to 6 weeks. I think it was probably 8 before I was live. And then from as soon as you commence live, it's constantly, you're always fine tuning what you're doing. And then you have a lot of meeting with your mentor earlier on. Once you're a little bit more established, then it sort of goes to, you'll have sort of a quick chat here and there, and then a formal monthly review at the end of each month.
Was it April or May that you finished the training, finished the sim, and you went live
Yeah, it was
halfway through last year? June.
during May. During May was when I went live. Yeah.
So you started in the office. Give us a picture of the scene in the office. How many traders are in there? How many trainees, for instance?
Yeah. Okay. So the in the office, all up, that would be trading sort of at any given time of the day. I'd say give or take 60, probably a little bit more actually. 60 traders would be in that office on a regular basis, each and every day. So you've got people that are trading just the Australian fixed income strip. They're mainly there during our day hours, when obviously all the volume is going through those markets. At the times that I'm there, I'm basically there sort of 2:33 in the afternoon through to sort of 2:30 or 3 in the morning. And there would be probably at least 30 people in the office that would do roughly those similar hours to me. But yeah, sort of experience level, out of those 60, I would say pretty close to half would have been there a year or less. And then another sort of 10 to 15 have probably been there around 2 years. And then you once you're sort of starting to get to those sort of last 10, they've sort of been there anywhere from sort of 4 or 5 years up to, I know one guy that's been there sort of well in excess of 10 years. There's people there that have also been there quite a while and have traded in previous places prior to coming as well. But yeah, the range of experience is quite vast, and obviously you get that's very trainee heavy, because obviously a lot of trainees do come in, not very many make it sort of through past the first year, second year, third year, and beyond that into their career.
And are you at liberty to say whether the majority of folks are trading derivatives of treasury products?
Yeah, correct. The most of pretty much all of what happens is people trading the Aussie treasuries, the Aussie bills, Aussie bonds, and also the T notes, the Eurex, like the bond and the bobble. It's pretty much that, like those sort of three areas on the Eurex, on CBOT, and on the SFE would encompass just about all. Not just about all, but the vast majority of what gets done. The other, if you also included people who trade the SPY mini, the SPY against the mini spread, you would pretty much have the vast majority of what goes on.
And from what I have established in our previous discussions, like the majority of it is people are spreading the Australian markets versus the US markets. Is that right?
Yeah, that's a lot of what goes on. That's particularly the guys that are there at night. They mainly are there at night because you can't really spread the Aussie markets against the US markets in our day session because there's just not the volume and the activity going through the US markets at that time. But the guys that are there to trade our markets against the US are there at the night time, because obviously that's when the US session is awake and active, and the volume is going through there. But yeah, spreading certainly. With the people that would mainly trade our day session, they'd be doing spreading the different bills. They would be spreading the bills against our 3-year. They would be spreading the 3-year against the 10-year. All the Australian products, the entire Australian fixed income curve, they're basically moving in and out of that.
Okay, so I get a pretty rough picture here that when I'm making a pipsqueak trade in the T-note late at night, there's a whole office of pros taking the other side of it as market makers, or if they see a spreading opportunity, which is probably worth keeping in mind.
Yeah, correct. Yeah, because depending on sort of where you're looking to take your trade, that's obviously going to be at a point where there's a bit of turbulence going on in the market, where there's a bit of a wrestle between the buyers and sellers, as sort of where you might be looking to take your trade, and they're all the spots that you look to be able to enter the spread, or enter at least one leg of your spread trade.
I'm interested, how old are the guys in the office? Is it a pretty young crowd?
Well, it would range. Youngest guy in there is 20. He may have turned 21 by now, but yeah, it's not unheard of for a 20-year-old trainee to come in. So, and then the oldest guy, he would be probably mid 60s. and he's sort of one of the guys that's been there he would have been there, well in excess of a decade.
He's the master.
He is the master. He's a
Is he the big swinger of the office as well?
He's one of. There's a few big swingers. He's certainly one of them. Yeah, so probably, from 20 right through to sort of that mid-60s. I would say probably the average age of trainees that come in would be, the mid-20s-ish, I would say. And then if you kind of took the average age of the whole office, it'd be close to 30, I would think. If you just average out everyone's age, I would say, close to 30. Keeping in mind that obviously you're frequently getting new trainees coming in that are younger, and not as many people sort of progressing and staying as they're sort of older. So you got that sort of, bottom heavy as far as the age range is concerned, I would say.
All right, so it's a fairly young crowd. I know they say, or someone says, that forget it, trying to get a job in a prop shop if you're over 30. But I'm sure if you can prove you've got your wits about you and they've got a veteran in there, then why not?
Yeah. Well, I certainly wouldn't. If it's something that you wanted to do, like I suppose part of it comes down to the logistics, and people in their mid-20s, generally speaking, don't have the commitments in their personal lives that people sort of 30 and upwards often might. As far as sort of families and that sort of thing, that sort of require that extra bit of consideration is to actually, can I make this happen in my life? So it probably comes down to as much a logistical thing as anything else. If you were, beyond 30, upwards into 40 and that sort of thing, and you got the passion for it, and you have the logistics that can support you doing what you want to be doing with it, then there would be no, there would be no reason why you wouldn't get considered the same as anybody else.
Oh, it's good to hear. There's hope yet.
Absolutely.
And all right, so you've got, say, maybe 50 traders in there at one point in time. Does it ever get heated in the office? Is there a lot of emotion swung about the place?
That was actually one of the biggest surprises to me. I suppose I had sort of the typical, you sort of read a few of the trading psychology books, and you pretty much
you're supposed to be a Zen monk.
Exactly,
right?
Yeah, that's it. And you're completely unaffected by the results of your trading and by the trades that you're currently in. That's you're supposed to be sitting there in this emotionally detached state. And there are people that do that. Certainly, don't get me wrong. There are people there that you can't tell at all what they're up to and how their trading's going, and that is how they like to sit there. But there's a full range of it. There'll be people that are strongly emotive when they're offside, and aggressively swearing and really getting anger out when they are offside. And then there'll be people that when they're offside they're really quiet, but when they're going well they can't sort of contain the excitement, and they're expressing their emotion when they're going well. Everyone's sort of got their own ways of doing things, and most people are acting in a way that does help them focus. It took me a few kind of weeks to see that when someone's just, for all intensive purposes, kind of just losing it, it actually is a trigger for them to get them in the state of mind that is required to effectively deal with that problem. Whether it's sort of getting out some of the emotion so that they've got some space left to be able to deal with it, I'm not sure. But most people are using it in that way. And certainly don't get me wrong as well, there are people that do lose it and it is to the detriment of their trading, and that's something that they do need to be working on. But I suppose, put it this way, there is no one in the entire office that doesn't experience that, let's call it the increased level of intensity when you're in a trade and it's going bad, or if you're close to taking a really good profit, or every single person sitting in there is sitting there experiencing that increased level of intensity. There's no Zen monk stuff going on. Everyone, regardless of whether or not they're showing it, everyone will be experiencing it. It's part of being a person. So that's probably... But yeah,
you're allowed to be human.
You're allowed to be human, and it's at times like the office will resemble a sporting arena. With the intensity and the emotion and the so much going on at once in small spaces of time, and some people are doing really well and some people are losing money, and you will feel the atmosphere as exactly like you do when you're at a tense sporting match where score is close and the end of the match is near and that sort of thing. It is quite similar. It's it was certainly something that took me by surprise.
So you'd probably have one big swinger on one side of a trade. Would you ever have the scenario of another big swinger in the office on the other side?
There's a very good chance that could be the case. Yeah.
Would they be aware of each other's the pressure they're putting on each other?
More than likely, I would say they probably aren't. If you sort of, they certainly well could, and they both could be executing a strategy, their own particular strategy, and both of the and they'll both probably have a good chance of making money out of it. I would say more than likely, if they're on opposite sides of the trade, they probably don't know about each other, but they very well could. They'd be more likely to know about it if you're more likely to know about it when you're on the same side as other people, and
everyone's high-fiving.
Well, yeah, or you certainly know it when you're on the wrong side of the market and a lot of other people are in there as well. You certainly you can just tell that that's going on. Yeah.
Love to be a fly on the wall during some of the exciting days. So, I suppose you've set a bit of a picture of the trading desk there. What's your particular setup? Have you got your own desk, or well, you've showed me, but can you explain for the listeners, like, where are you sitting? Have you got a whole wall of monitors in front of you?
Yeah, sure.
What's the picture?
So basically the office is set up in very long rows of desks, and so there's sort of basically 4 or 5 rows, and you'll have sort of 12 to 15 people on each row. I'm making it sound a little like you're kind of squished in a bit, but you're not really. You've got plenty of space for yourself, full sort of desk to yourself. Yeah, that's right. I've got 3 monitors in front of me. One monitor. Each of those monitors is attached to a different computer. So you've got sort of one computer and one monitor that runs the TT trading software. I've got another one that's the charting software, and then another one that's sort of the news feed and the email and that sort of thing. So you got sort of those are the 3 sort of setups as far as like monitors. There's always sort of CNN or Bloomberg. The financial news channels are sort of always on. There's a squawk, obviously, that's coming over whenever something significant comes up. But basically, the office is sort of set up nicely as far as there's lots of sort of inspirational things around, like signed sporting jerseys and pictures back from sort of the pit trading days. There's sort of like a mural, like a Bulls and Bears mural down one of the sides. It's all sort of set up to be, reasonably stimulating environment, because you obviously do spend a lot of time in there, and it's it is reasonably comfortable. There's sort of couches if you want some downtime, and
a chair you can have a nap on.
Yeah, well, see, middle of the European session, if it's a bit quiet and you've been sitting there a while and you've got no positions, and you might as well go and have a quick kip, and if you've got some time to do that before the US session begins, you'll see people doing that definitely.
And I think you mentioned previously in a chat that you had, what I struck was weird was you share a mouse or something for your chart screen. Is that correct?
Yeah. So the charting software, I share the charts with 6 people, like the sort of 6 people that sit closest to me. Basically, each group of 6 people shares a charting machine. So how that sort of works is I've got my own monitor with my own charts set up on there, and so I can always view the charts that I want to be looking at. But we all, if you want to manipulate the charts, then only one person can obviously be manipulating the charts at a time, and you just sort of drag the mouse over to kind of do what you want to be doing with the charts. Initially, when I arrived, because when you do the trial, the online course at home, you've obviously got your own charts that you're using, and you can manipulate the charts as much as you like. And I was certainly in the frame of mind of you need to be fiddling with the charts every 2.5 minutes to make sure you don't miss anything. And so initially, when I arrived, and you really don't have that easy access to manipulate the charts. You can always view what you want, but you can't actually fiddle with the charts, and that took some getting used to. I was very used to scrolling and expanding, contracting, and pulling up different correlations, and all the sorts of things that you think are very necessary at the time. And now I would sort of go in and I'm probably using the mouse at the beginning when I'm sort of making my plan, making my strategy for the day. And then after that, you may only touch the mouse once or twice more for the remainder of the time that you're in there.
So it's really just there for a point of reference if you need it. You're not supposed to be engineering trading decisions like during the market action. Asking someone, can I please have the monitor, please? I'm just going to figure out how I'm going to trade here. It's all just to look at the history, get a reference.
Yeah, and sort of back up what you're, back up the idea that you're having. Essentially, you're, what I kind of ended up finding was that when you don't expand and contract the price scale or the time scale all the time, and then jump in and out of different, am I looking at a 2-minute bar, a 5-minute bar, like 15-minute bar, and jumping between them all, just having the one setup sitting there, that gives you a bit of consistency in the perspective that you're viewing. And I much prefer now having that consistency there. I think it disorientates me if I was to be going in and going, let's look at the 5-minute, all right, let's look at the 15-minute, let's expand the time frame, contract the price scale. I think you lose the perspective and you get sucked into things that aren't necessarily there if you're constantly chopping and changing, whereas when you've got that same setup that you're used to looking at all the time, I think it maintains your perspective much better.
If you're manipulating charts, you're probably trying to create some backup for a trading decision on the fly.
It's and it's when something unique is happening, such as like when you're going to be trading during FOMC or non-farm payroll or something like that. I don't necessarily have the same setup that I would for all other times, because obviously you really only need crucial pieces of information at the exact time you need them. And so when I'm trading something that is going to be like NFP, you would set up your charts differently so you've got access to them. Just sort of to have that additional, I suppose, acute perspective. You need you got to really limit the information that is coming at you when NFP is going on, because you just can't take in too many things at one time. You really just want to have one or two things that you're trying to look for, and then you can make your decision. If you got 4 or 5, you just can't make a decision quick enough trading during NFP or an event like that.
But I suppose I should point out or make clear, you have your TT DOMs up. Is that what you're staring at most of the time?
Yeah, that's right. Most of the time you are looking at the TT DOMs, and also you're always aware of the relative position of the different markets that you're looking at. Have the Aussie 10 years moved further than what the T-notes have, or something like that?
Yeah, okay. And so, how much, like, everyone in the office is spreading? Does anyone take outright positions?
Well, the crisp answer to that is no. No one's looking to do anything that is solely outright. To sort of clarify that a bit, though, essentially, like what you will often try to do, if you're of the belief that, say you're happy to spread one market against another, and you think that the bonds are going up, you might, say, for instance, enter a long T-note position, and if bonds go up, then your outright position is fine and you make some money there. But essentially, what a spread trader will do is they're already happy to be long the T-notes as part of a spread. And if they get into that long T-note position and it's not working, it starts to go against them, rather than cut a loss, they'll enter the spread. And entering the spread at a point where they're already happy to be long the T-notes as part of that spread, and that allows you the time to be able to work with it when you've already formed your view of the spread, that you think you'll be able to either manage that position back to a profit, or depending on what happens, you might just be trying to manage that back to a scratch. But the other way to look at sort of how someone would incorporate outright trading is, if you were to form a view on whatever time frame that you trade, doesn't matter what time frame, that say that you of the belief that bonds are going down, you might be able to establish an outright short position, and you'll have sort of a target in mind. But as we sort of know, it's reasonably uncommon that a market will move from your entry through to your profit target without swinging back, a reasonably large amount, taking profit away that you sort of had down there lower. So what a spread trader will be able to do is establish that outright short position, and then once the market has fallen a certain amount, they'll put it in the spread. So you'll buy another market, and then the idea there is obviously to make a little bit of money as the market trades back through the fall before it then continues down. So you're constantly moving either in and out of the spread by taking off one whole leg, or you might be just going underweight and overweight a different leg of the spread to express the idea that outright T-notes are going down.
Okay, so we just talked about outright trading and everyone's spreading, but you're happy to be in an outright position.
The important part there is you do still form an outright view of what's going on, and there are times where your analysis can lead you to the conclusion that it's very high probability that bonds are going down today, and you want to be on the short side of bonds. But there'll be very, very few occasions where somebody will go, okay, I'm going to get short the T-notes and I'm just holding it for the next 4 hours. Or until this profit target, or whatever the case may be. That's not how somebody will trade it, because usually you can get more profit from trading the back and forth that happens while the T-notes might actually drop half a handle, but they might sort of go, say, down 8 ticks and then up 4 and then down a bit more, and trading that two-way by being in and out of the spread, the T-note might have dropped half a handle, but you might actually be able to pull more profit out than that, because you're also catching these pieces on the long side while you're holding on to your short position to actually go down and meet it. But it all needs to be done in the context of the spread. You have to be entering the spread at a point that it makes sense to do so. It's no good just having that as your strategy if it doesn't actually make sense from what the spread chart actually looks like. But the short answer there is the way someone will express an outright view is to move in and out of the spread while they're doing it. It'd be very, very unlikely that someone would just short the T-notes and hold and sit there and do nothing. There's just more opportunity than that, and you just get shaken out of that trade too easily. It'll go down 4 ticks from your profit target and then come halfway back, and you'll get scared out, take a small profit, and then it'll go down and hit your target. And you were right, but you've pulled such little money out of your idea. Whereas this more active, dynamic approach of being in and out of the spread to still express the same trading idea is what people sitting in the office would be doing. It makes sense to everybody to do it that way, to have that more hands-on, active approach.
Why can't you have an outright for each of those scenarios? Why is it easier to put a spread in for the rebound than reverse your outright position? Is it because of the size it's being traded, perhaps?
Yeah, that would be part of it. There certainly are people that would be trading size that's they've established a core position, and if that is in something like the Aussie 10 years in the night market, it may be a little bit too big to be able to be getting in and out of that. Size could be part of the issue, but generally speaking, you're kind of just coming back to that idea that if bonds are going down and you've established a short position at a really good spot and that short position is on side, you don't want to mess around with that too much. You'll lose your short position and not have the exposure then to the move that you're actually anticipating. If you it just allows you to lock in some profit by putting on the long to catch a bit of the bounce. You don't have to be the wizard and catch all of the bounce. But if a bounce of 8 ticks happens and you get 3 or 4 of them, then that's just adding value to your overall short position, giving you the confidence to be able to hold on to it. Because, as you'll know, there are times when an outright position will go down and you can just see that it just wants to have a little bounce. It might only be a few ticks. But at that point, the risk and reward of just sitting there holding your outright short and not doing anything versus getting into the spread, making a couple of ticks or 3 ticks on the long side, and then pulling that off and letting the whole thing continue, that just keeps you... It's just tighter. It's more efficient. It's you got much more control as opposed to, well, I'm short, I'm 10 ticks on side. What am I going to do if this comes back 9 ticks on me? You know what I mean? You haven't pulled anything out of that move, whereas in and out of the spread you obviously have.
I suppose we started out this time or just before last year. We were looking at the same sort of introduction to day trading, the same. Would have been the no BS day trading material. Do you look at the same sort of things as such as like steps in the profile and size trading in the context of your spread trading?
A little bit. They're not things that I look for at the beginning of sort of decision making, and even they would even be things that they don't necessarily have to be there for me to be entering or exiting a trade. If they are there, then that's good, and I do see value in them. But also the thing I probably found with them is it's very much an art observing that price action and working out who is muscling who around, or who is just showing size without actually intending for that full size to go through. When all of those games that occur, it's very much an art, the interpretation of those games, and so sometimes it's clear, but very often it's not. And for me, if I'm kind of waiting for a really clear time, you don't get all that many trades. That probably is a skill thing. I don't have as much experience and as much skill watching those, that price action happen at those key points. I'm sure that some people that have spent a lot more time than I have watching that would be able to operate more effectively in that environment. But yeah, for me, it's sort of I just try to have my perspective, keep my perspective bigger than those games that go on, and just sort of I'll look at a period of price action like that as a spot of turbulence where there's plenty of back and forth, and that the back and forth is what I use to be able to enter and exit the spread.
I think you might have mentioned a while back that like the spread is your main point of reference, and you guys are kind of trained to, if the spread is right, get in and manage your trade. Would that be a good summary of your triggers for trades?
Yeah, correct. Because the waiting for a really juicy spread price is the same sort of thing. It's just not going to come up frequently enough that you're taking enough trades, and you're going to leave a lot of trades where there is 1 and 2 ticks profit available in there. You're just not going to be touching them. And plus the other danger of sort of waiting until the spread is very, very stretched before you do enter is you may be entering at a point where the spread is about to blow out. It's not going to do what you're expecting it to do. If it actually reaches a reasonably extreme point, then it can quite easily go further. So the idea is you do need to be standing in there reasonably close, and a lot of the times you'll just be able to move through the spread, and it will behave as you're expecting. It's the times when it does slip against you and you do find yourself offside in the spread is really where you need to begin trading and managing that position. Ideally to a profit. You can certainly be on the wrong side of the spread and trade it well enough to pull a profit out. But there are times as well when you really are just looking to a scratch or to minimize the damage.
How much size is getting thrown around in these spreads in your office? Would you have any clue? Like, are we talking thousands of contracts?
To give you the entire perspective, when you first begin live, your maximum size, I'll just use the T notes, and then everything's sort of equivalent size to the T notes. You would have a maximum that you're able to use of 3 T notes. That's sort of very initial. You've just gone live. Reasonably quickly, you get more as you've demonstrated a bit of consistency, sort of 5, 10, moving up higher. There would be certainly plenty of people there that would have a maximum size of 50. There'd be a number of people in there that have a maximum size in excess of 100, and then there are people in there that would be playing with more than 500. To sort of put a bit of perspective on that, though, somebody who is trading that kind of size, obviously you can move 500 contracts in and out of the T-note. Except for the Asian session, you can pretty much do that without pushing the market against you in the T-note. But that's sort of that comes down to the safety and the flexibility and the versatility of the spread, being able to enter with that much size. If somebody for whatever reason who had 100 contracts was to take a purely outright trade without looking at the spread at all, they would probably only put 10, 15, or maybe 20 of their 100 on, because of it's much more, it's a far riskier trade to be entering an outright position in one of those markets as opposed to being in the spread. There's far less you can do with it to minimise damage if you're wrong. So they certainly wouldn't be entering that kind of size in an outright trade.
One thing, I suppose, that it's really important to trading then is how much does reviewing your trading come in to your success?
Reviewing, yeah, obviously, certainly important thing, but you can't necessarily do it too frequently. Essentially, you need to sort of develop a strategy, and then just go about trading it, because it's not going to work every day, and you kind of need to just let it be and let it go for probably at least a week, maybe even a lot more than that sometimes. If you're reviewing things too quickly and changing things around, you're kind of curve fitting to how the market's been for the last couple of days all the time, and it's sort of a process of you already do that a little bit in your interpretation and in your execution each day. But yeah, I would say reviewing it is an important thing, but it can't be done too frequently. You can overdo it and sort of lose the benefit of going through that review process.
Is someone on the ball enough in the risk monitoring department or mentoring department to tap you on the shoulder if you did start mixing things up a bit too much?
It's not really their job. They wouldn't really come and intervene unless you're really doing something that you definitely shouldn't be doing. In other words, like you have more size on than you're actually allowed to trade, because we've all got extra limits to be able to stack the order book that you're not actually able to enter. You're not supposed to be in that many contracts, but you got enough to be able to stack the order book and things like that. So they'll come and intervene if you're doing something really that you shouldn't be doing, but slight changes in your strategy, they wouldn't actually know that you'd sort of done that, because everyone essentially has their own way of doing things, and everyone does, even though they're kind of trading similar products, they're doing it in their own way, and so that's not really the job of risk. And they wouldn't actually know unless it's unless you're really like doing something you're not supposed to be doing. There's no one to tap you on the shoulder and say you shouldn't be doing that.
So at the end of a trading session, everyone's not going through a compulsory review time, especially we're talking about the trainees and the guys that are in maybe the same boat as you, who have a mentor still that reviews their trading monthly with them. Are you obliged to be pulling up charts of your fills or recordings of the tape and reviewing what your execution was like?
What you do when certainly while you're on the sim, and then certainly for at least a few months while you're live, the first few months while you're live, it's not as much of a technical process as that. There's just sort of 4 or 5 questions that you answer, not in such a it doesn't necessarily have to be in such a tangible way. Like you might, one of the questions is what was my best trade today, what was my worst trade today, what did I learn from today that will help me tomorrow. They're sort of more general type questions to jog your mind, to get you thinking about that review process. It's not so much a sit and look at a replay of your trades, or look at like printouts of where the different trades were executed and things like that. That's not a day-by-day thing. You obviously can do it if you did want to. The one time when you do sort of print out the charts and go 1 minute chart, here's my entry, here's what I was thinking. If you stop out, if you hit your stop on a particular day, then that's something that you need to kind of you'll sit down with your mentor and you'll have a discussion and work out why you were doing what you were doing, and if you were following your strategy, and basically the thoughts behind the process of how you stopped out. And it doesn't necessarily mean that you've done something wrong if you've stopped out. You could have done exactly what you intended to do, but the market just didn't agree that particular day, or you might have really gone far away from your strategy on that day, and that's sort of what that's designed to do. But that sort of intense review really does only come at that particular time.
Do you have like a hard set of rules that you will follow religiously?
Yeah, the hard set of rules, that's something that it probably took me the best part of last year to kind of allow that to not have to be there. It was something that I really wanted to be there. That's part of my personality, and sort of part of, I suppose, how I was guided from the retail stuff that I did, to be wanting this precise set of formulas and checklists, and when these things are all sort of falling into place, that's when you trade, and then you get statistically reliable results and that sort of thing. I wanted very much to kind of sift everything down to have that, but it was sort of explained to me on numerous occasions that that's just not how it works. You can't get it down to such a like that. That's essentially what an algorithm is trying to do. Like algorithms are going to be able to execute that far more efficiently and far quicker than I would ever be able to do it. And it's not something that is going to be a profitable thing, to have you so boxed in and so tight that you only take action when you've got all these criteria being hit. And so that was a big part of sort of a mental shift that I did have to make, that you really come up with, say, a core philosophy and maybe like one or two beliefs that support that core philosophy, and that is the framework within which you operate. And then you have to be dynamic and fluid and flexible enough to work out what that actually means on any given day. And then obviously, what has been working for a couple of weeks can instantly stop working. And if you've got these rigid set of rules that you're trying to execute every day, you won't adapt fast enough to that change in conditions, and you'll still be trying to execute this rigid set of rules, and you'll give back your profit. Whereas allowing that sort of more dynamic frame of mind, you'll still get tripped up when conditions change, and you'll still give back money, but you're open-minded enough to realize what's going on at the time, and you're far more likely to realize why you're giving money back and what actually did change and what you need to do to start operating in the new market conditions, if you just have like a core philosophy. And the basis of my core philosophy is a belief in the relative value, that essentially, like, products that are related to each other will not move too far out of alignment with each other, because there are lots of people with big money that are fading them all back in. And it makes fundamental sense that these markets will remain in relative value with each other. So that's really like the core philosophy that is behind my strategy, that is fluid and adapted to the conditions that are prevalent at the time.
Well, I think there are textbooks out there that say you can have rules that will tell you when to change your rules. Sounds a lot easier just to treat it as a skill.
Yeah, yeah. Rules that'll tell you when to. Yeah, that's right. Yeah.
You segregate the market into 10 different personalities. You have a different set of rules for trading each of those personalities. I mean, come on, is anyone sitting there with pages, a manual of checklists on how to trade in the office?
Well, this is it, and I think it does come down to a bit of like the personality type that traders, that trading generally attracts. Obviously, like, it attracts all kinds of people, but there are people in the office, and I've throughout sort of the time that I have spent trading, I've met numerous people that have made the transition from engineering to trading. And engineering is all about sort of rules and procedure and formula that gets executed, and then the sound execution of a set of rules or formula leads perfectly to the result that comes at the end. And it's a nice environment to be operating in, when you can tick all these boxes and the outcome then becomes pretty much inevitable. And it's sort of my personality likes things to be that way as well. But it's just, that's not how the market works. It's far more dynamic than that. And sitting there and refusing to believe it just because you find it nice to be able to check off a formula and get a result would just end up in frustration.
So we'll agree that, yeah, trading is a skill. That was going to be one of my questions. Is trading just a skill that can be learnt?
Oh, I very much think so. I think it is very much a skill that can be learnt. There'll sort of obviously be, everyone, when they begin learning a new skill, whatever it is going to bring all sorts of different backgrounds with them. Some backgrounds are going to enhance your ability to pick up the skill quickly. Some are really going to be a lot of hard work to undo things that you're bringing with you to pick up the new skill. But at the end of the day, it's a skill, and it's just an environment that you begin that you learn to operate within. Biggest difference probably is you can have success in a lot of occupations, and previously I experienced success in teaching by being able to do things that control and direct and manipulate's not the right word, but you got this influence you can have over the environment to guide the whole situation to an outcome that is beneficial for everybody involved. You can actually have a reasonable amount of influence over the environment, through social skills essentially, to be able to get the result that you're after. And you just can't apply that to the market. There's just no way that you can have the control of the situation to guide it to that particular outcome, because it's much bigger than any one person or any one organization. And if you have experienced success by that kind of methodology before, you naturally try and bring that methodology with you, which is where in trading you'll go into the checklists and the formulas and the rules and the just tick all the boxes, and then you end up with the inevitable outcome. You'll naturally bring that kind of approach because you've had success with it previously. And as I did, end up very, very frustrated that how you've experienced success before is not working this time, and wondering why.
Well, how long do you think it takes, to learn a skill then? Learn the skill of trading. So, A, you're not blowing up your account. B, you can grind away some ticks. Were there trainees that just started crushing it after a few months in the office?
Yeah, there's a huge difference in the results of early trainees. Absolutely, there's people that that immediately go backwards in their account and stay backwards for a while. There'll be people that sort of go backwards and then come forwards and go forward from there, or someone might be really quick out of the gates for the first month and then go backwards from there. And but yeah, there are examples of people that have done really well, initially positive in their account and have just moved forward being positive from there. Like through sort of having conversations with the people, it's kind of, you never really can know what beliefs and values that they're actually operating from to be able to obviously have that success. Sometimes like it really would be possible that you could come in with just absolutely no idea of what's being done, and then you get all the drills and you get a simple strategy of what you're going to trade, and because you don't actually know anything else, you'll probably execute it really, really well. And you'll take money out of the markets most days just because you've got nothing else going on, no preconceived beliefs, that you're able to actually interpret what's being taught to you and execute it very closely to how you're supposed to. Whereas, you bring along some preconceived beliefs, like I certainly had the belief that, trading was this clean, crisp, binary event where, you just sort of get in and you look after your risk and reward and you get out. And, that's the market just doesn't behave in that nice kind of way most of the time. And if, I'm taking this view in, that's going to seriously impede my ability to get into the spread, get in and out of the spread, taking small profits. And, because I'm of this belief that, well, I want to be short bonds tonight, and why aren't they falling down already? Whereas somebody who's just executing the strategy as per being taught to them might have been in and out of the spread and actually pulled 6 ticks out of the market, and the market's gone nowhere because they've been in and out of the spread. Whereas if I'm executing this clean, crisp strategy and the T-notes haven't actually fallen yet, I've made no money out of it. Does that make sense?
Yeah, well, it's the less is more effect.
Yeah, that's right.
The more you know, the more you can you'll potentially overthink scenarios and get caught in a loop, and before you know it, the opportunity's gone.
That's right. Yeah, yeah. And you see, it's sort of a case of people that have been there sort of between the 1 and 2 years, who don't sort of make the end of the second year. It's not because there's not talent there, but it's because you kind of are at that point where you know so many things, and they're all, you're starting to try and put too many things into your decision-making process and second-guessing yourself all the time.
Take some trades, grind some ticks, don't overthink it.
Yeah. As simple as that sounds, but it's just the execution is not necessarily an easy thing to do.
You've spent 9 hours a day. How many trading days did you miss last year?
Well, yeah, it's nine would be the minimum. You're really you're basically there for sort of 12 hours. If it is quite during the European session, like I will go and have a sleep or go to the gym or something like that. So it's nine's really the minimum of what you sort of are in there. Yeah, well, it was I think prior to the Christmas break, there was one day that there was time off on the Easter long weekend because obviously all the markets are closed. So I did have time off on the Easter long weekend, but then apart from that, there was one Friday that I did take off in that sort of whole period. It's
So you could have potentially spent upwards of 3,000 hours watching the Dom, learning the skill of trading. Do you have any other major lessons from 2013 that you took away from that?
well the biggest one is that belief um, that it should. There's I'm sure there's a quote in some of the trading psychology somewhere that's something to do with if it feels like it's hard work, then you're doing it wrong. And I always had this in my mind. Like if I've gotten into a position and the position in the spread is offside and you're kind of battling your way to get back to a scratch, and it's a reasonably at times stressful thing that you're trying to do. And my belief prior to coming in was that trading should be this effortless thing. If you're in a good trade, it should be effortless to execute, and that just plain isn't reality. The best trades are difficult to get into. The market doesn't want to let you in. You'll need to sort of pay up to be able to get into that price. And the bad trades, the ones that go against you, the market is letting you into them really, really easily. And essentially, it comes down to as a speculator, you are providing liquidity. You are taking on the risk of somebody else who doesn't want the risk for whatever reason, and you're paid to be uncomfortable. It's uncomfortable to buy right at the low of the T-notes when they look like they're about to fall off a cliff, but the spread says that this is the time to buy them. It's an uncomfortable thing to do. But that's when you get paid. You get paid to sit there and feel that and be uncomfortable. If you're waiting for so much confirmation that this trade is going to be a winner and you've got your comfort level so high before you enter, there's usually no money left in that trade. It's or the market's about to do something strange that is going to result in a loss. The times when you get paid are when you're getting in and feeling uncomfortable, and it's nothing to do with a clean cut process. It's you got to be in and out. You got to be fluid and dynamic with it, and that's definitely the biggest lesson for this year. I was trying to execute this clean, crisp process where you don't go offside very much, and you can kind of keep it all very controlled. And that was it took me all year to work out that belief was there and having a negative impact on what I was trying to do every day.
But you became aware of it, and now it's 2014, and it's a year to crush it. Am I right?
It is a year to crush it. Yeah, it's a year to crush it. You can't help but wonder if are there other things there that I'm kind of holding, these other core beliefs. Are there other ones there that are kind of standing in the way at the moment? In one sense, it's kind of an exciting thing to find out something like that. And then there you kind of have that moment of frustration that you've spent so long until you actually discovered that and kind of held yourself back from upholding this belief that is essentially very unresourceful. But yeah, so part of me wonders, will that what ones of those will I find in 2014? But then you've always got that excitement that you sort of you're bringing things together constantly. And I had some good momentum from the end of last year and sort of essentially ready to go with it.
Well, we read even with the market wizards and such that it's a constant learning curve. There'll no doubt be some new eureka moments about trading beliefs and obstacles to overcome. But definitely wish you the best trading in 2014, and hopefully we can catch up with you somewhere down the line, see how you're going, see if you've got any new insights for us.
Yeah, certainly. No, thanks very much, Graham. I'd certainly be happy to speak again. It's it probably helps me as much as anybody else who might be listening to talking these things over. You end up sort of with a better perspective on how you're sort of holding all these things together in your own head, really.
Yeah, I agree. It's great hearing what you have to say. And I suppose one last question for you before we end this: will the world fall apart in 2014?
There's always a good argument for why the world should fall apart, and there's plenty of traders that'll sit there and get really, really excited about the prospect of of some really good volatility going on. essentially that's the stories of what may and may not happen is what's going to influence the markets day by day. And you always want something going on that is keeping everyone on their toes. And there'll always be something that comes up. Remember sort of early last year, it was all about Europe, and Europe was a big problem, and there was the weekend when all the stuff happened in Cyprus, and there's the Italian elections, and all of that was really what was driving all world markets. And Europe by the time we got to the second half of the year, European data was having very little influence over the Aussie products and over the US products. Essentially, like, Europe was just there on the back burner, and everyone was all on the taper story. When's the Fed going to be tapering, and what effects that going to have? So there'll certainly be something that's pushing the markets around. It doesn't necessarily have to be doom and gloom, but it certainly can be. But no doubt there will certainly be something going on that keeps everyone interested and keeps it all moving around.
Well, thank you very much, Michael. We'll see if the world holds together then.
Well, that's the thing. It always does. It always
does. All-time highs. Fed is tapering. Hopefully, there are ample opportunities for you in 2014, and really look forward to catching up with you in the future.
Yeah, thanks, Graham. No, great chatting.
Thank you for listening to the Sound Trader podcast. We will definitely be back with more interviews with real-life traders. So be sure to subscribe and definitely check us out at www.thesoundtrader.com.